Okay. So number 4, valuation and multiples. Now, every business may not like understand valuation and multiples, and it may not be the season for them to engage in activity that covers valuation and multiples. And I'll go into details of what that means, right? But the general rule of business, you have to understand that no matter how good your products or services are, you're only worth what someone is willing to pay you for, right? And that's it. Like, in terms of the valuation of your business, you have to understand how market dynamics work so that you can understand what you're worth, right? So it's like if you are applying for a job and you personally need $100,000 to survive, right? But what's the market paying for that type of job? And that's ultimately what you can negotiate on. You can't negotiate and say, hey, Troy J. Neal needs 100,000 and I can't take this job if the market's paying 80, right? But if the market's paying 200, I can't go, you shouldn't go in there and say, hey, I only need 100,000 to live, and then they'll give you 100,000. So it's all about understanding that valuation and what the market is telling you. So, the way our economy is set up is a free market economy, right? So businesses can set prices however they feel for all their products and services, right? And in exchange, theoretically, customers have choice. They can choose A company, B company, C company. In business valuation, it's a little bit more complicated, where you add in what your competitors are doing to determine that price. So it's not just you, it's the comps that are out there and what other businesses are trading at, right? And trade is simply just exchange. It just means exchanging through buying and selling. That's all trade means, right? Just like trading a baseball card or trading a stock. So I think, it's, you can have a highly demanded service or product, right? You can execute well on it. You could have a unique market opportunity. You could have all these things and be successful. But if you're the only company, let's say, that does that one thing, or one of a few companies that does that thing, then that's where your valuation can be much higher, right? So again, it's not about the products or services, how good they are. It's about how much someone's willing to pay you for it. And that's determined by certain things outside of what you're going to execute. It's just market dynamics. So the most common way that businesses are evaluated is through a multiple, right? So, and just breaking that down very, very simply, a multiple is just a number. So it's just a number. All it is a number multiplied by another number. So it's not too complicated, but what that number, that multiple number times another number, which is usually some type of financial metric, is enterprise value. So that's called EV in short term. You'll hear that term sometimes, but enterprise value is that multiple times some type of financial metric, enterprise value, right? So investors or buyers of businesses use multiples when they're comparing similarly sized industry competitors, right? And that's just comps that we talked about. Similar to real estate, right? Like real estate, you use comps to price houses. Like there's no magic formula to it. There's no like number that has to be this, has to be that. It's just what houses are trading for at that particular time. You sell it, or you're looking to sell it at a certain time, interest rates are higher, maybe that affects comps, maybe that affects, what's going on. So real estate, buying real estate and thinking about the comps, how real estate comps are used, is very similar to how business comps are used. So in publicly traded companies, right, like there's usually equity multiples are used, and the most common one is like PE ratio, price to earnings ratio, right? And then in privately held companies, EBITDA multiples are typically used. That's the most common one these days. And it's interesting because you have like these companies that are like unprofitable, right? But they'll be unicorns, right? And a unicorn is a company worth over $1 billion, but they're unprofitable. So they're not making any money, or they're not making any profit, let me say that. but they're unicorns. They're worth billions of dollars, or they're pre-revenue. Maybe they've never earned any money. They're just spending money, or maybe they're it's just interesting things, but they could be worth that amount of money, and it's usually through some of this evaluation, right? So it's like, sticking with the real estate example, like houses. Not all houses in the same neighborhood with the same layout are worth the same amount, or can sell for the same amount. Let me say, like, you can have the same layout, same neighborhood, and maybe house A has a roofy leak, needs updates in the kitchen. House B doesn't, right? Same house, same neighborhood, same layout. That house A could be worth less than house B, right? And we know that. So similarly, investors are looking at those analysis of businesses. And just like home buyers, like, in a sense, some investors want a fixer-upper, and some investors want the move-in ready home, right? Just like buyers. So some investors say, hey, this is devalued. I want to buy this company while I think it's on the rise, and I can get in and, get some appreciation for my asset. Some want that move-in ready home. They want that, in that strongly desired neighborhood, and you want the modern layout and all of that. And then that home particularly could be part of a bidding war, where that particular home, not all homes, is risen to a level higher than the comps. So it's very similar in business. The same way, if you have a company that is has a perceived value, some type of value, right, and from an investor standpoint, they think there's some type of value attached to this company that maybe is unique to them, only they can do it, or they're one of a few. Maybe they're in a highly desirable industry. Maybe it's an industry that's booming right now or picking up, like AI. Everyone's talking about AI right now. NVIDIA is, it's a company like that, right? And then typically they may have like some type of sustainable competitive advantage, right? They're the only ones who do that. They can balloon in terms of their value to billions, just simply on that. So it's not even like thinking about like the sole financial metrics, just looking at what the market comps are given. So the skill is just evaluating that value and being able to determine what's a good investment, what's not, similar to like any other investment. I think what's interesting is that some of those, like, to just tie the knot on this, like some of those unprofitable unicorns, or like companies of pre-revenue that are worth billions and billions and billions of dollars, like, how is that possible, right? That is possible because it's usually like maybe two things. Maybe it's like they have some type of access to like some customer data that no one else has access to, or some proprietary data, or they're providing some type of product or service that has future iterations, right? Like today, Amazon is a bookstore that sells books online. The future iteration of that is I can sell everything to you online. Top 5, again, cash flow and financial statements, private equity and venture capital, lending, valuation and multiples, and the last one is revenue and business segments. So there's a lot more that goes into all of these different aspects. Again, it's really having your partners by your side so that you are not expected to be the expert in all of these different spaces, but you know these things, and you can have that confident conversation. If you're speaking with an investor, you're speaking with that potential partner, you're speaking with that vendor, that client, whoever your banker, right, or lender, it just equips you to be better prepared.